bridge the shortfall in returns. Essentially, this year, the EPFO has announced an 8.1% interest rate, which is the lowest in 4 decades. It is still better than a lot of other options Indian investors have. Let me first go across to my colleague Alex Matthew, who's breaking down the numbers.
The Employees Provident Fund Organisation paid investors a rate of 8.1% for the financial year ending March 2022. That was ratified by the government last week. And while this was the lowest in over 40 years, it is significantly higher than most other schemes and investments that are predominantly fixed income related. Just as a benchmark, take the 5-year fixed deposit at State Bank of India. That stood at 5.5% in the last financial year. And the Public Provident Fund, which, as you know, is another government-sponsored savings scheme, that offered 7.1% in the same year. So how was it possible for the EPFO to pay 8.1%? Now, in the release that it sent out in March to announce the rate, it said that it liquidated some of the investments that it made in equities, which helped supplement what it earned from its debt investments. But the EPFO didn't always invest in equity. The decision to invest 5% in equity ETFs was taken in 2015. That was raised to 10% in 2016 and 15% in May 2017. Now, reports are suggesting that the EPFO is contemplating raising this further to 25% in a phased manner, first to 20% and then to 25%. Having said that, India's pension fund has been much more conservative than its global peers. As an example, the Canadian pension fund, called the CPP, has 27% of its assets in public equity and 32% in private equity as on March 31st, 2022.
All right, now the question is this a good idea to increase the amount that is invested in equities? And the bigger question, can the EPFO consistently continue to give the high returns, relatively higher returns that are expected? Remember, EPFO is a contribution that is not really voluntary. All salaried employees have to make this contribution, and which is why crores of Indians really depend on the kind of interest rates which come from the EPFO. More importantly, this is one of those investments which is exempt. That means when you actually withdraw your money, and it's supposed to be a retirement nest egg, you don't have to pay a tax on it. Keeping all of this in mind, what is the best way forward? To speak on this, I'm joined today by Ajay Bagga, Chairman, Elements Platforms and Market Expert, and PV Subramaniam, CEO of www.subramani.com, also with us on the show. Welcome to both of you. Mr. Bagga, let me just begin with getting your take. I mean, even the decision to start investing in equities and in incremental flows in equities for the Indian EPFO is a relatively recent one. Do you think it's time to take this further?
It's a difficult one, Tamanna, because markets will go up and down, and when they go down, it becomes a political hot potato. So it has to be dealt with very carefully. But overall, if you see the trends, if you see the top 7 pension funds in the world, which account for about $52 trillion of assets under management, they are like 75% in equity and alternate assets, alternates being private equity, real estate, commodities. The hunt for yield is on globally because pensions are underfunded. To make sure that they are able to deliver retirement pensions to the savers who have contributed to it all their lives. So it's a difficult one. It's got political overtones. But if you look at the last 50 years track record of the top 30, 50 pension funds, it is the way to go. There is no other way, because bond yields will keep coming down over time. They will not be sufficient to meet all the obligations. And it's better to invest in diversified equities on very long periods of time. Our EPFO has been very conservative in that they are only investing in ETFs run by State Bank of India and UTI, which are looked upon as quasi-sovereign mutual funds, and they're investing only in ETFs. So that's the good thing. But markets will be cyclical, as we saw in March 2020. But globally, funds made about 27% then as the markets recovered, and they could fund a lot of their shortfalls thanks to the equities going up. So case by case, we can see across geographies where it has worked. There is a lot of data and research backing this, but it is a political hot potato.
So the reason it is a political hot potato is because, like I mentioned, it's not voluntary. There is no great social security net for salaried employees, and EPFO is supposed to be one way of a forced saving so that when people retire they have something with them. In that context, Mr. Subramaniam, what is your take on increasing the equity component? Because as great as the equity returns are, that element of risk is then introduced into something which is held very close to the hearts of Indian people, especially salaried employees.
Tamanna, first of all, it is not understanding risk which is the problem, because over such a long period of time, the biggest risk is inflation, and in a country where inflation is close to 7-8% constantly, we need to have equity. But having said that, we have some kind of a unwritten rule that the money is guaranteed by the government of India. Do you think there will be a year when EPFO will say, sorry, we made a loss, so instead of 8% return, we are giving 4% return at a time when, let us assume that PPF is giving 7.75? I don't think it is possible. The government will put its hand into it still and pay it up, right? So that is what will happen, because we have been very protected. Look at Rajasthan. They already want to go back to the old system of saying we will give you defined benefit pension, right? So that's not, we are not a country which will tell people that, look, you have made this loss. For example, EPFO does not care about mark-to-market gain or mark-to-market loss. You have said you've invested so much and this much is the return that you will get. If EPFO makes losses in, say, ILFS, somebody pays it out. So we are a very, very protected country. So we will want all the upside of equity. We will not want the downside of equity. So I think ETF is a good, sensible thing to do. But do we have the guts to go beyond, say, 20% of the whole corpus? I doubt. I doubt whether we will want to go that much.
The point about an unsaid, unwritten rule that you're guaranteeing it is actually very clear, isn't it, Mr. Bagga, that they have to give that much of a return, that your money which is put into the Employment Provident Fund is secured. And no government will come and tell you that, too bad. I mean, even in COVID pandemic years, we had about 8.3%, no matter how they managed to do it.
Yeah, absolutely. That's why I said it's there are the trade unions who are sitting on the board who look at the stock markets as gamblers' dens. So we are stuck in a very 1950s kind of a scenario. I was reading up on CalPERS and Casters, the big US pension funds. Even in the 1950s, they had moved to 25% equity. And then they realized equity is not enough, so they moved to alternatives. So there is a lot of data, especially on the superannuation funds of Australia, which are the top performing funds. If you see Norway, which has taken out its oil money and created pensions for all its citizens. They are very first-class, excellent examples of how risk can be managed.
What are the kind of returns they give, and do they guarantee returns like India does?
No, they don't guarantee. So it happens. I used to work for Temasek, the Singapore Sovereign Fund, which also manages the pensions, the Central Provident Fund. And in 2008, it went down 28%. But then in 2009, it made up also. And today it is multiple times. Tamanna, if you look at the top 7 big funds, they have doubled in the last 20 years, despite being in very low yield environments. And the forecast is they will double again in the next 10 years. We are still sitting at 210 billion when a small country like Malaysia has 250 billion. Singapore, with 6 million people, has $350 billion in its fund. Norway, thanks to its oil monies, has $1.3 trillion. Japan, which is one-fourth our population, has $1.7 trillion. And the big reason has been that they have espoused these higher risk and higher return products, and that has helped them to fund their pensions. If you look at corporate pensions, Boeing is the largest pension fund in the world. Then you have General Motors, you have DC, you have AT&T. All of them have about 75% in non-fixed income, because there is no other way of funding the pension in that scenario. And they're giving dollar returns of 8 to 11%. Here we are struggling for a rupee return of 8%. That talks volumes for the kind of returns people are making.
So in terms of the amount of money under management, it could also be, and when you compare it to the size of the country, it could also be a reflection of how much of our population is in formal jobs where, you're generating EPFO funds. So you might have to adjust a bit for that as well. But I think the key factor over here and the key differentiator, Mr. Subramaniam, that you mentioned is that we guarantee it. So even if our size of fund doesn't grow, or if we don't grow at a massive rate, at least we know it's there. There is no risk to it. Do you think that that is something which will continue to be maintained? And in the coming years, is even an 8.1 going to be difficult to do without significantly increasing the investment in equity?
I really don't know, because there is the question of not taking risk. I'm sure EPFO put money in ILFS. Maybe they kept it in some of the banks which went bust, but quietly the government pays up. So that is very important to note, that we will not ever admit in public that there was a mistake and something like that happened. So we have to accept what we are. And I do think that 99% of our investors don't look at risk at all. For example, even if you give them 2% return, but you tell them your 100 is protected as it is, they will be happy. They don't look at real return. Real return means the return minus inflation. So if the government is very nicely able to hold inflation at 4%, let's say, then you should be very, very happy with even with the 5.5% kind of return. But unfortunately, we are not great at communicating this. So I think there is some kind of an unwritten law that we will not give a return less than the PPF. So will we make losses? What do? We quietly pay up. So those kind of guarantees, which means what our union leaders will want is the upside of equity without the risk of equity. Who is going to bear the risk? Government of India, because we only have left and further left and super left. We don't have any right kind of thing. So, and remember, you're protecting a very, very small portion of your population. Your farmers and your laborers nobody is protected by Provident Fund. So Provident Fund is protecting a very small set of people. They will continue to be protected. So even in MPS, Tamanna, now we're going to see a loss in the portfolio, and there is a mark-to-market with interest rates going up. Are we going to be able to convey that to people? Those people who have put all their money in debt in the NPS will see a very, very poor return going forward for the next 1 or 2 years. Are we going to have the heart to say you're getting 2% return or 3%?
No, they wouldn't have the heart, and part of it also because did we have a choice? Did EPFO subscribers ever get a choice? You can actually, you're saying it's a very minuscule part of the country or population which is protected, but it is also because that is how the whole thing is designed. You start a job and you start contributing to the Employment Provident Fund, whether you want to or not, whether you understand it or not.
I agree, but most people don't know to do even that, right? They would take their money, put it in some crypto and lose it or things like that. So at least their money gets protected. So what I'm saying is, Tamanna, even people with 5 crores and 6 crores have got that protection, right? So is the government saying only up to 10 lakhs is protected, beyond that is not protected? No, everybody is protected. Till last year, everything was tax-free, or maybe 2 years ago, everything was tax-free. It was a very, very luxurious thing. So now, accept it. If you want higher return, you will have to take higher risk. And along with that, there will be one 1993 when you get a minus 46% on your equity, and that will hurt your return. What will you do with it? What will you do this year when interest rates go up and the value of your portfolio comes down? I want to see the government handling the communication in NPS, the debt, the gilt portfolio. In gilt, you're going to see a bad return for the next 1 year. How are we going to handle even that messaging? NPS is also not voluntary, Tamanna. People have to choose between NPS. People have to just choose how much in equity and how much in debt. But even NPS is not voluntary. There is mark-to-market loss, which is going to happen. Now, take a year when interest rates go up and equity markets go down, you're going to get a poor return in NPS. I'm very, very eager to see the government handle that communication.
Well, communication will definitely be one challenge, but the bigger challenge is how to make good on these promises and the expectations of Indian salaried employees going ahead over the years. And that's a can you can't keep kicking down the road. Well, thank you so much, Mr. Bagga and Mr. Subramaniam, for joining us on the chat this evening.
Thank you, Tamanna.